This video is for educational purposes only and is not investment advice. Please consult a financial advisor before making any decisions.
All right, here's how we're going to break it down. We'll start with the technicals, then dig into the fundamentals. After that, we check the market sentiment, look at the big global picture, and finally, wrap it all up into an actionable verdict. Let's dive right in.
Okay, Section 1, the technical picture. Look, before we can even think about where the price might be headed, we have to understand where it's been. So let's see what the charts are telling us. The last few months have been an absolute roller coaster for gold. A huge rally kicked off in late 2025, and then it went completely vertical into late January 2026, smashing a new all-time high. Of course, what goes up that fast must come down, right? So a violent correction followed, shaking out all the speculators. And that brings us to where we are now, this methodical, quiet period where it looks like the big institutions are quietly buying. And that all-time high, a jaw-dropping $5,600 an ounce. That number was the absolute peak of the frenzy back in January. Now check this out. We're looking at the weekly chart, and this pattern here is what traders call a bullish hammer. It's a huge tell. It means that sellers tried to slam the price down, but buyers rushed in with so much force that they pushed it all the way back up. It's basically a signal that the sellers have given up, and it happened right around the critical psychological $5,000 level. The buyers are in control.
And that leads us to a super important concept for what's happening right now, the Bollinger Squeeze. The easiest way to think about this is like a coiled spring. The market goes quiet, volatility dries up, and the price gets squeezed into a super tight range. It's often the calm before the storm, a sign that a huge explosive move is coming.
And boom, here it is on the daily chart. This is a picture-perfect example of that Bollinger Squeeze. You can see the price coiling tighter and tighter, just wrapping itself around that 20-day moving average. The analysis here is that this market is building up a ton of energy for a major breakout. So the chart is screaming that a big move is coming. But why? That takes us to Section 2, the fundamental drivers. Let's look at the actual economic engine that's powering this whole setup. Okay, this is where things get really fascinating. For decades, there was a simple rule. High real interest rates were absolute kryptonite for gold. End of story. But that rule, it's broken. Gold is now rallying despite those high rates. The market is telling us something has fundamentally changed. It's not worried about missing a few percentage points of interest anymore. It's worried about the health of the entire system. It's pricing in systemic risk. And you want to know who's one of the biggest buyers? Central banks around the world. In 2025 alone, they snapped up a massive 863 tons of gold. That's physical gold being taken right off the market. And at the very same time, what are institutional traders doing? They're placing enormous bets against the US dollar. We're talking a total net short position of negative $22.8 billion. That creates a powerful tailwind for anything priced in dollars. And guess what gold is priced in? This leads us perfectly into market sentiment. So the charts look good, the fundamentals look strong, but who is actually doing the buying? And maybe even more important, who's been selling? Let's find out. So let's look at the futures market, which is full of fast money traders. At the peak in January, they were holding over 251,000 long contracts. Now, that number has collapsed to just under 160,000. This is what you call a washout. The weak hands, the people just chasing the price, got scared and were forced to sell. That actually cleanses the market and builds a much stronger base for the next leg up. But here's the contrast. While those speculators were dumping their positions, the strong hands were doing the exact opposite. Physical holdings in gold ETFs just hit a brand new all-time high of 4,145 tons. This isn't just paper trading. This is serious long-term money buying and holding the actual metal. And you know, this might be the single biggest long-term bullish argument. This chart, it's incredible. It shows that gold ETFs make up a tiny, tiny fraction, 0.17%, of U.S. private financial portfolios. Think about that. The huge rally to $5,600 happened, and the general public wasn't even at the party. The potential for future money to flow in here is just enormous.
All right, let's zoom all the way out now. The widest possible lens, the global situation. What are the big picture geopolitical and systemic risks that are causing this flight to safety? Well, a major shock just hit the system. A recent Supreme Court ruling invalidated some key federal tariffs. This one decision instantly blew an estimated $2 trillion hole in long-term U.S. budget forecasts. That's a huge blow to the country's fiscal stability, and, you guessed it, it weakens the dollar.
And while that's happening, the U.S. stock market is flashing its own bright red warning lights. The Warren Buffett indicator, which compares the total value of the stock market to the country's GDP, has hit 220.1%. That is a level signaling historic overvaluation. It's even higher than it was right before the 2022 downturn. Okay, so we've looked at the charts, we've looked at the fundamentals, we've checked the sentiment, and we've sized up the global macro storm. It's time to bring it all home and synthesize everything into the final, actionable verdict from this analysis. After putting all of that data together, every single piece of the puzzle, the verdict is clear and it is definitive: a strong buy. The conclusion here is that the risk versus the potential reward is skewed overwhelmingly to the upside. And this isn't just a vague idea, it comes with a complete trade plan. The entry zone is identified as being between 50.50 and 51.18. The line in the sand, your macro stop loss, is set at 48.16. Then on the upside, you have 3 distinct profit targets, with the final one being a retest of that all-time high at 5,600. Then you leave a core piece of the position to run, targeting $6,000 and possibly even higher. And this isn't some fringe view. It's being echoed by the big players on Wall Street. For example, JP Morgan's own research is pointing to long-term structural tailwinds that they believe could push the price of gold all the way up towards $6,300 an ounce. So there you have it. We've walked through the entire multi-layered analysis. The charts, the economic data, who's buying, who's selling, the global risks, all of it weaving together to form one single cohesive thesis. And it really leaves us with one final thought. Now that you've seen how a professional case is actually built, layer by layer, how does it change the way you look at a simple price chart?